Most people think the stock market is one big gamble. They believe people are randomly clicking buy and sell, hoping to get lucky. But here's the truth. There are only a few real ways people make money in the stock market, and once you understand them, everything becomes clear. In the next few minutes, I'll show you exactly how investors build wealth and why most beginners fail. Let's start with the most obvious method. Number 1. Buying low and selling high. You buy a stock at $10. The company grows. More people want to buy it. The price rises to $20. You sell. You just doubled your money. That profit is called capital gain. Sounds simple, right? But here's the problem. Most beginners try to predict short-term price moves. They panic when prices fall, they get greedy when prices rise, and they end up buying high and selling low. That's the opposite of what works. Now let's talk about the second way people make money: dividends. Some companies share a portion of their profits with shareholders. If you own their stock, you receive a payment, usually quarterly. This is called dividend income. For example, many established companies on exchanges like the New York Stock Exchange pay consistent dividends to investors. This means you can earn money even if you don't sell your shares. Think about that. You own a piece of a business. That business earns profit, and it sends you part of that profit. That's powerful. Now here's the third way, and this is where real wealth is built: long-term growth. Companies like Apple Inc. didn't become trillion-dollar giants overnight. Investors who believed in the company years ago and held their shares saw massive growth over time. This is called long-term investing. Instead of trying to trade daily price moves, long-term investors focus on strong businesses. They ask, is this company growing revenue? Is it profitable? Does it have a competitive advantage? If the answer is yes, they hold sometimes for years. Now here's something important. There are two types of market participants: traders, investors. Traders try to profit from short-term price movements. Investors focus on long-term business growth. Both can make money, but beginners often underestimate how difficult short-term trading is. It requires skill, discipline, and emotional control. Long-term investing, on the other hand, relies more on patience and consistency. And historically, patience has rewarded investors. But let's address the risk. Yes, stocks go down. Yes, markets crash. Yes, you can lose money. But here's the key difference between gambling and investing. Investing is based on ownership of real businesses. When you buy a stock, you're not buying a lottery ticket. You're buying part of a company that produces goods, provides services, hires employees, and generates profit. Over long periods, strong businesses tend to grow. That's why time in the market often beats timing the market. Now let me summarize everything clearly. People make money in the stock market through capital gains, buying at a lower price and selling at a higher price; dividends, earning a share of company profits; long-term growth, holding strong businesses as they expand. But success depends on knowledge, discipline, and patience. Not emotion, not hype, not following random tips online. In the next video, day 4, we're going to talk about something extremely important. What is the difference between trading and investing? Which one is better for beginners? And why do 90% of new traders lose money? If you want to avoid beginner mistakes and actually understand how to approach the market properly, don't miss day 4. Subscribe to Dollar Radar, comment day 4 if you're following the series, and I'll see you in the next lesson. This is your financial education step by step.